Hello friends, how are you all? So let us continue our lesson number 15. We are discussing miscellaneous topics in this lesson and this is the sixth video of this particular lesson. Okay, in this particular video we are going to study about Reserve Bank of India's risk provision accounts. Okay, this is an important topic. It has been in news for the last 2-3 years also, and therefore we need to understand what are these. Okay, Reserve Bank of India's risk provision accounts. So see, I'll give you some background of this. What is the background? See, just like any other bank or company or even government institutions, Reserve Bank of India also has a balance sheet. Okay, so this balance sheet terms, it is coming again and again, and that's why I have explained it to you in detail in the previous lesson. What is a balance sheet? So just keep in mind that in balance sheet, Reserve Bank of India also has a balance sheet, and there are assets and there are liabilities in a balance sheet. Just like any other institution, Reserve Bank of India also has a balance sheet. Now what will come under the assets of Reserve Bank of India? Okay, so there are some assets like gold that Reserve Bank is holding. Obviously it is the asset of Reserve Bank of India. I'm just giving you the examples, it is not the exhaustive list. Okay, then Reserve Bank of India is holding some foreign securities like US treasury bills or foreign bonds, etc. So they are known as foreign assets. Okay, FA. Then Reserve Bank of India is also holding some rupee assets, rupee bonds, and bonds issued by the government of India. So they are known as rupee assets. Okay, RA. Then apart from that, there are other reserves that the RBI is holding in the form of SDR and other things. So all the things which are assets of the Reserve Bank of India, they come on the asset side of the balance sheet of RBI. Then there are certain liabilities also. Now what is the liability? Liability is something that the Reserve Bank has to pay, okay, which it owes to other people. So obviously the first thing that will come here is the currency notes. Okay, currency notes. See, here I am only talking about currency notes and not the coins. Okay, because coins are issued by the government of India and not by the RBI. Coins in India are printed and issued by government of India and not by the RBI. They are given to the RBI for circulation, but they are not printed by RBI. They are not minted by RBI. So coins and 1 rupee note. Okay, 1 rupee note. These two things are minted by government of India and not the RBI. They only give it to RBI to circulate it in the economy, and therefore it is not the liability of RBI. Okay, it is not the liability of RBI. So for accounting purpose, this 1 rupee note and coins are put into the asset side of RBI. Okay, they are not put into the liability side. Just try to remember this. So in liabilities, currency notes, that is rupee 2 and above notes, which are printed by RBI and circulated by RBI. On that note, you must have seen that there is a promise written by the governor of India that I promise to pay the bearer a sum of 20 rupees if it is a 20 rupees note, or a sum of 50 rupees if it is a 50 rupees note. So basically RBI governor has put a promise that when whoever produces this note, I'll give him the purchasing power of 50 rupees. Okay, or 20 rupees, 100 rupees, whatever. So basically it comes under the liability of RBI because RBI owes that value to the people. So currency notes is basically the main liability of RBI. Then there are other things like as we know that the CRR reserves, right? Other kind of reserves that the commercial banks keep with RBI. So that also RBI owes to the commercial banks, right? So again, that comes under the liability. So there are these different components. Now, just like any other institution, RBI, since it also has assets and liabilities, so there is always a chance of fluctuation in the RBI's assets because of, see, the gold prices may go up and down, the prices of foreign assets may go up and down, rupee assets may go up and down. So obviously there are always a chances that the RBI's balance sheet may be disturbed. So that is one reason why RBI's balance sheet may be disturbed. That is this revaluation in gold value or foreign asset value, rupee asset value, or change in the exchange rate. For example, today, say if the rupee appreciates, so if the rupee appreciates, that means dollar depreciates, right? If the rupee is going up, that means dollar is going down. But if we are holding some dollar securities, then the value of those securities will go down because it is denominated in dollar. So exchange rate fluctuation are also there. So that is also a risk on RBI's asset side, the balance sheet. Then RBI undergoes a lot of monetary policy operations, right? It increases the policy rate or it decreases the policy rate, it increases the money supply, decreases the money supply. So because of this increase and decrease in money supply, what happens? If the money supply is increased, what will happen in the economy? Money flow will increase, the credit will increase. So it may happen that there is overheating in the market. So again, that will result into some risk with the RBI's balance sheet. So there are different activities that the RBI does which may impact its balance sheet. So in order to protect that, any institution, they always have a contingency fund, right? Contingency fund meaning the fund that they will use in the time of emergency. If there is any financial emergency in when we talk about RBI, so they can tap into those risk provision account, okay, in order to account for risk. Okay, some provision meaning you are keeping some money in safe in order to use whenever there some vulnerabilities happen, some actual risk they emerge in the economy or in the banking sector. So therefore RBI has different types of risk provision accounts. The first risk provision account is the contingency fund of RBI. Okay, it is CF. This contingency fund is different from the contingency fund of India. That is the part of the budget and all that I have explained it to you, fiscal policy. That is a different contingency fund. That is contingency fund of the government of India. This is contingency fund of RBI. Okay, don't confuse these two. So this is a contingency fund with RBI which it can use when it is a specific provision for meeting unexpected and unforeseen contingencies. See, what is a contingency? Contingency is an event, okay, an event which may occur in future, but there is no certainty about it. Okay, there is no certainty, meaning we don't know when it will happen, how it will happen, what will be the scale of it, right, how much damage it will cause. So that is known as contingency. For example, earthquake is a kind of contingency. Okay, like it can happen, it cannot happen, but we have to keep some some provision for it, right? So similarly, there are different situations in which RBI may need this kind of fund. So what is the first is a depreciation in value of securities. As I have told you, if the value of securities that the RBI is holding, if the value depreciates, if the value goes down, that is a contingency on RBI balance sheet, right? Then risks arising out of monetary and exchange rate policy operations, right? There are different risks associated with it. Then there are some systemic risk also, right? Systemic risk meaning the risk in the banking sector, okay, in the financial sector. What happens if the entire system fails? What happens if there is some financial crisis, if there is sudden collapse of the banking system? So all those are the systemic risks. Then risks on the account of special responsibilities of RBI. Okay, the RBI undergoes some special responsibilities, like it is a lender of last resort in case of bank runs. So bank runs basically is a situation in which all the depositors of bank, they will go to the bank and they will ask for their money back, their deposits back, even before the maturity, because of the rumors that this bank is going to go bankrupt. Okay, so basically that is known as bankrupt. So in that case, since bank does not have all the cash available with it, because it has given loans out of those funds, so it cannot get back all the loan at one, but it has to give back people their deposits. So that situation is known as bank run. So in that case, RBI will help those banks, and that function of RBI is known as lender of last resort. Okay, so it is a special responsibility. Because of this also there is some risk involved. What happens if 2 or 3 banks they are facing the problem of bank run, and what if the RBI has to undergo the what if the RBI has to act as a lender of last resort? So there is always a contingency involved. Then financing government budget deficit. What if the government budget deficit is too high? RBI has to finance it, right? It is known as printing money basically. Okay, printing or creating new money. So what if RBI has to do it? If RBI is printing money, its liabilities will go up, right? So it has to provide for some assets also on the opposite side of the balance sheet. So these are the different situations in which RBI will use its contingency fund. Now, where does this contingency fund come from? It comes from the profit of RBI. Okay, so RBI earns some profits, right? So RBI basically earns its profit from from the monetary policy operations, from the reserve requirements, from from the interest it charges to the banks on the loan that it gives. So from the profits of RBI, it puts some money into the contingency fund. Okay. Then the second risk provision account is the currency and gold revaluation account. Okay, the name itself suggests this is the money which the RBI gets when there is a revaluation in currency and gold value. Okay, so to take care, when it will be used, it will be used when there are currency risks, to take care of the currency risk, then interest rate risk, movement in gold prices, or whenever this kind of situation arises, RBI will tap into this account. Then it is a buffer against the exchange rate or gold prices fluctuations. Okay, it is a buffer against that. And under pressure, when it will be under pressure, this account, whenever there is appreciation pressure on rupee. As I already told you, whenever there is appreciation pressure on rupee, that means rupee value is going up, dollar value is going down. Therefore, the foreign assets or the dollars or the foreign currency that the RBI is holding, its value will go down. So whenever its value will go down, that means the RBI's asset will go down. Okay, so in that case, the RBI may have to use this currency and gold revaluation money. And whenever there is a fall in gold prices also, because gold is also a kind of reserve with the RBI, it is an asset of RBI. Then the third one is investment revaluation account. Okay, foreign securities, FS, or foreign assets, FA. Okay, so it is known as IRA-FS. Okay, I have mentioned it here. So investment revaluation account of foreign securities, the name itself suggests you that what will go into this account, the unrealized gains or losses on revaluation in foreign dated securities. For example, RBI is holding the US securities, US government securities, okay, which have a maturity of 30 years. Okay, 30 years maturity. So dated securities means long-term securities. Okay, long-term securities. It can be bond, it can be any other different kind of financial instrument. So long-term securities, if RBI is holding that, maybe in this 30 years the prices will go up and down. So for example, when RBI purchased this, say if the RBI purchased it in 2015, say for example, if it purchased US government securities at $1 each, and say for example it purchased 100 such securities, so the value in 2015 will be $100, right? Now what happens, if in 2016 this value of this security becomes only 98 cents, okay, $0.98. So obviously the total value will become $98. So this $2 is kind of unrealized loss for the RBI. See, why it is called unrealized? Because RBI is not actually selling these securities in the market after 1 year. It is still holding it, but on account, on the book of the RBI, this $2 is the loss of RBI. Okay, unrealized loss. RBI is not actually selling it and incurring loss. Similarly, if the prices go up, for example, if in 2017 the prices become say $1.02. Okay, $1.02. In that case, the total value will become $102. RBI is not going to actually get this 102 because it is not selling those securities. So they are unrealized gains in that case. Okay, unrealized gains and losses, meaning it is the book accounting gains and losses. Okay, you are not actually realizing it. You are not actually getting that money. So whatever these kind of gains and losses happen because of revaluation of foreign dated securities, that gains and losses will be accounted in the investment revaluation account of foreign securities, IRA-FS. Similarly, if the RBI is holding the rupee securities, dated rupee securities, that is Indian securities, it will be the revaluation gains, unrealized gains and losses on revaluation of such securities will be accounted in the IRA-RS, in investment revaluation account, rupee securities. So I hope you have understood this difference. Now there is another important thing that we need to study. It is about the Special Rupee Vostro Account. Okay, SRVA, very important topic. Now what is the Vostro account and what is the Special Rupee Vostro account? Let us understand. So Special Rupee Vostro Account, SRVA, is for settling of payments of imports and exports in rupees. Okay, exchange rate is market determined in this case. See what is happening. Recently you must have heard that so many countries, different countries, they have agreed to settle the international trade in rupees. Settling of international trade in rupees means what? They will make payments in rupees. Okay, for example, if they are importing something from India okay, imports, for example, Singapore imports, say, edible oil, okay, edible oil from India. And now previously Singapore used to pay India in terms of dollars, but now after this, after the RBI allowed payment in rupees, international trade, now Singapore can pay India in rupees. Okay, it can pay in rupees. Since a foreign country is paying India in rupee terms, it has to hold the rupee reserves also. It has to hold rupees somewhere in its bank accounts. Only then it can make payments in rupees, just like we hold dollars and other countries hold dollars. Now if the countries are making payments in rupees, it has to hold rupees. Okay, so rupee can become an international currency in that sense, because it will be used for international transaction. Okay, so SRVA is a bank account which is there to settle the payments of imports and exports in rupee term. Okay, and what will be the exchange rate? For example, if Singapore dollar, okay, so for example, if the Singapore dollar, one dollar is say 50 rupees of India. So if this is the market exchange rate, so obviously on the day when this this is settled, on that day, whatever will be the exchange rate, that will be used to pay in rupee term. Okay, for example, if they purchased edible oil of say 100 Singapore dollar worth, and on that day if the exchange rate was 50 rupees, then obviously they will pay 50 multiplied by 100, that is 5,000 rupees. So this is the how it happens. Now it was started in July 2022 when RBI issued detailed guidelines on cross-border trade and transaction in rupees. Okay, after the Russia-Ukraine war, it had come into picture. You must have read it in the current affairs also. Now 8 countries have opened about 50 SRVA, Special Rupee Vostro Account in last 6 months to trade in INR, in Indian rupees, and 18 countries have agreed to trade in INR. Okay, and out of these 18 countries, 8 countries have already opened Vostro accounts in the last 6 months. Okay, there are more than 50 Vostro accounts as of now. Now how these Vostro accounts function, let me explain it to you. Okay, so Vostro account is, for example, what happens is, there is an authorized bank in India. For example, it is the SBI. Okay, there is an authorized bank in India. Okay, there is an Indian importer. So somebody is purchasing goods from say Singapore. Okay, so here is a Singapore country. So from Singapore, some Indian importer has imported some goods. For example, it has imported say mobile phones. Just giving you an example. Okay, mobile phones, Indian importer has imported. Now it has to make payment to foreign trader in rupees. Now since the import and export payments are being done in rupees, it makes payment to the foreign trader in rupees. So he will make payment to the authorized bank in India. Okay, now there is a partner trading countries bank. Okay, so there is a bank in Singapore, say for example, this is a DBS bank. Okay, DBS bank is a very famous bank of Singapore. Say for example, DBS bank is a partner bank of SBI in Singapore. Now what will happen, this so these authorized bank will open a SRVA, Special Rupee Vostro account, and maintain it. Okay, for this partner trading bank. Okay, so account will be opened in Indian authorized bank of the partner trading bank. Okay, so DBS bank will open a SRVA account in the SBI bank. Now what is happening, this Indian importer is paying to the SBI, and it has to pay, this payment has to be sent to the Singapore through DBS bank. So now this DBS bank has an SRVA account in the authorized bank, so this money will be credited in the SRVA account of the DBS bank. Okay, and then DBS bank will make payment to the Singapore party. Okay, so that is how it is done, and this money gets credited in the SRVA account of this bank. Okay, this whatever the Indian importer is paying, it is paying to the authorized bank. This authorized bank will credit that amount to the SRVA account of the partner trading bank of that country. Okay, I hope you have understood. So this is how this entire thing happens. Similarly, when an Indian exporter, okay, if we are selling something to Singapore, for example, okay, if we are selling something, so payment will be made by the Singapore party. So what they will do, they will make payment to their partner bank, and now since this partner bank has to pay to India, this money will be deducted from their SRVA account. Okay, it will be debited from the SRVA account. Similarly, when Indian exporter has to be paid in rupees, amount from this Vostro account will be deducted, will be debited and credited to the exporter's regular account. Okay, whatever regular account it has in the SBI, it will be credited there. So that is how it happens. Now, SRVA holders are allowed to invest surplus balance in Indian government securities. For example, see, if this DBS bank is holding an SRVA account in SBI, and say for example if there are say 100 crore rupees in that account, so it can use that 100 crore rupees to invest in Indian government securities. Okay, it can do some diversification of portfolio, it can use that money to earn some profits. So it is allowed to invest surplus balance in the Indian government securities. Now, authorized banks can open multiple SRVAs for different banks from the same country. Okay, so it's not like that SBI can open only one account for Singapore, or it can open only one account for Canada or Russia. So it can open multiple accounts for different banks of the same country. So for example, if in Singapore there are different banks, say for example there is HSBC bank, then there is DBS bank, then there is POSB bank, different bank. So these different banks for the same country, they can open different accounts in one authorized bank of India. So that is why 8 countries, they have opened about 50 Vostro accounts till date. Now this was about that. Now friends, since this is a miscellaneous lesson, I also wanted to discuss about some economic curves. Okay, I just wanted you to understand what are the, because sometimes it is there in the news and in the articles also. So I just wanted to tell you what is the meaning of these curves, and if at all you come across these names, you will have some understanding of it. So that's why I'm explaining it to you. And as of now, friends, this will be the last video. Okay, last video of this lesson series, of the prelims lesson series. And with this I'm finishing the UPSC Prelims lesson series. That's why I'm winding it up. If there is any new topic or anything is left, if I feel, maybe I will come with 1 or 2 more videos, but for all practical purposes, we are finishing the prelim series now. So that is why I wanted to mention these economic curves in the last. Okay, don't worry if any topic is left, anything is remaining, if you feel like, you comment in the comment section, I can cover those topics also. But as far as I feel, I think this should be sufficient. So the first curve that I want to discuss with you is known as the Kuznets curve. Okay, Kuznets curve. So what is this curve? Basically on this curve, on the y-axis there is inequality in the country. Okay, inequality, and on the x-axis there is income per capita. Income per capita meaning what is the per capita income of the country. If the per capita income increases, that means the country is developing, country is growing. Correct. And if inequality is also, so usually it is says that whenever the country is developing, inequality also increases. So this Kuznets curve says that up to a certain point the inequality increases. Okay, up to a certain point of per capita income, when the country is developing, up to a certain level of development the inequality increases, and after that it falls. So India, I don't know where it is, maybe somewhere here it is there, because still we are growing and we are developing, and inequality is also increasing in India. Maybe we will reach this this apex, this plateau, and then we will come back down. So usually this is the phenomenon that is seen in the world. So Kuznets curve say that whenever a country develops or income per capita increases, initially the inequality increases and then it falls. That is the simple meaning. Then the next one is yield curve. Yield curve, we have already seen this. So basically this is the bond yields. Okay, bond yields, and this is the time to maturity. So maybe if the bond is for 1 year, 5 year, okay, 10 years, 20 years, 25 years, 30 years, 40 years. So the normal yield curve is that it is upward sloping, meaning higher the time to maturity, longer the term of bond, higher will be its yield. Okay, and whenever this yield curve reverses, meaning if it goes like this, it is known as reverse yield curve. Okay, so this is a situation I have already explained it to you in previous videos. Then there is another important terminology which is known as the Phillips curve. Okay, so Phillips curve is basically a trade-off. Okay, the compromise between unemployment and inflation. Again, on the x-axis there is unemployment rate. Okay, and on the y-axis there is inflation rate. So it says that as you go on to reduce inflation, if the country is aiming for reducing inflation, unemployment rate will increase. Okay, so it will increase the unemployment rate in the country. So this is a Phillips curve. Obviously this theory does not hold good in practice, but just try to understand what is a Phillips curve. Phillips curve is basically relation between unemployment and inflation rate in the country. Then another important curve is the Laffer curve. Okay, Laffer curve. What is a Laffer curve? Laffer curve talks about, on x-axis there is tax rate. For example, say, government tax rate, say income tax rate. Okay, income tax rate. And on the y-axis there is a government revenue, the revenue that the government earns. Now it says that Laffer curve is like a, initially when the tax rates are increased, so government revenue will go on increasing up to a certain point, after which it goes on decreasing. Okay, because after this point people start evading taxes, and people will work less because now government is taxing them more. At 100% of tax, okay, if the tax rate is 100%, government revenue will be zero. Why? Because nobody will work. 100% tax meaning, for example, if you are earning 500 rupees, government is going to take away this 500 rupees as tax. So nobody will work, right? Nobody will work. So at 100%, this, government revenue will be zero. So Laffer curve says that, initially when the tax rates are increased, up to a certain tax rate, revenue increases, but then after that it falls. And at 100% it is zero. So this is the Laffer curve. Then another one is a Lorenz curve. Okay, Lorenz curve is basically, it shows what is the inequality in a country. Okay, so this is a little bit technical. Just try to understand that, for example, on the x-axis, there is a cumulative share of people from lowest to highest income groups. Okay, so for example, say of all the Indian population, okay, you are dividing them into different income groups. For example, people who are earning, say 0 to 5,000 rupees per month. I'm just giving you an example. Okay, 0 to 5,000, then 5,000 to say 20,000, like that. And then you are going up to highest income room, maybe 1 crore and above. 1 crore and above. So all the people who will be in this income group 0 to 5,000, okay, will be considered in one group. Then this is another group. So basically on x-axis you are putting people like that it is a cumulative share of people from lowest to highest income group. Okay, so up to 5,000, say if India's 10% of population is earning 0 to 5,000, then 5,000 to 20,000, say another say another 10% people are earning. So up to 20,000, 20% people are earning, right? 0 to 20,000, 20% people are earning. So like that. Okay, and here there is a final 100%. And on the y-axis we have cumulative share of income earned. Okay, so of the total national income, of India's total national income, say this is the lowest, this is the 5% income, this is the 10% income. So here it will be the cumulative share of income. Now this is known as line of equality. So see, line of why? Because it is a 45-degree line, meaning what? If this is the 5% of people, if 5% of people are there and they are earning 5% of they are earning, say, so say for example, if it is 20% of people, okay, 20%, lowest 20% of people are earning 20% income. So it is a equality, line of equality. But in actuality there is no equality in a country. Line of equality does not exist. So what exists for a country is a Lorenz curve. Okay, this curve. So Lorenz curve is like this always. It is it is below the line of equality. Now what does a point on Lorenz curve indicate? See, I'll tell you here. For example, consider this point. Okay, so on this point on x-axis, if it is 50%, say for example, so it means what? This is the 50% of people of the country, cumulative share of people from lowest to highest income group. So this is the 50% people of the country, and corresponding point on the y-axis is the share of the income earned. So now they are earning only, so on the line of equality, if you put it here, 50% will come here, but this 50% of people are earning only 20% of income. So see, there is inequality. So 50% of Indian people, lowest 50% Indian people, they are earning only 20% income of the country, right? And remaining 50% are earning 80%. So there is inequality. So this Lorenz curve indicates how much is the inequality in the country. So this Lorenz curve, ये जितना नीचे होगा, as much as it is down, it will indicate more and more inequality. And as it goes closer to the line of equality, the inequality in the country decreases. So this is the Lorenz curve. So friends, I just wanted to mention these important terminologies. I hope you have understood them. If you have any questions, any doubts, any suggestions, please let me know. I hope you have liked this lesson series, and if time permits and if my schedule allows me, I will come up with a series for mains also. Okay, so for mains, all these topics that we have discussed for prelims are also important. Okay, for it's not that that these prelims topics are only for prelims, it is for mains also. So you have to study these topics for mains also, but in mains there are a lot of additional topics also. So if possible, I'll come up with a different series for mains, and let us see how it goes. But I hope you have liked this series. Please make your own notes. That's what I just wanted to mention, because unfortunately I don't have any written PDF or any printed PDF of these notes. Okay, so I am not able to basically provide you the notes here, but I'll try to take screenshots if possible, and I'll give it to you in a very short time. And but I highly recommend that you make your own notes out of it, and just watch this series 2 or 3 times, and definitely your doubts will clear. Okay, please comment and recommend it to your other friends also who are preparing, and that will be a great service for me also. Correct, that it will reach as many aspirants as possible. Please recommend it to others. Please subscribe to the channel for new updates and for new videos, and I hope to see you soon again. Thank you.